Welcome to the Deep Dive. It is May 6th, 2026. And I want you to imagine something for a second. Imagine opening your brokerage app and seeing these record-breaking, just champagne-popping highs across all your tech holdings.
Oh, yeah, the dream, right?
Right. But then literally 10 minutes later, you're driving to the grocery store and wondering if you're going to need a payment plan just to buy a carton of eggs.
Yeah, that's a harsh reality.
It really is. And that is the exact split-screen reality the global economy woke up to this morning. We are pulling from the daily market briefing for today, and the overarching theme is just this massive contradiction. How exactly can major stock indices be shattering records, seemingly totally detached from gravity, while the broader global economy is, essentially trapped in a pressure cooker of inflation and geopolitical tension?
Well, it is a profound disconnect between corporate execution and everyday consumer reality. And to really understand the forces at play today, we can't just look at the raw numbers.
Yeah.
We have to examine the physical constraints of the technology that's driving this boom. And then how those physical constraints collide with the macroeconomic roadblocks that are keeping central bankers awake at night.
Okay, let's unpack this, starting with the numbers on the board, because they are staggering.
They really are.
The S&P 500 gained 0.9%, the Nasdaq is up 1.1%, both securing brand new all-time records. The Dow Jones rose 0.7%. But looking at the briefing, this upward momentum isn't like a broad rising tide lifting all ships equally.
No, not at all.
It is heavily, heavily concentrated.
Yeah.
We are looking at absolute titans like Apple, Amazon, and TSMC delivering what Wall Street calls triple plays in their earnings reports.
Yeah, and what's fascinating here is that the triple play is, it's really one of the most rigorous stress tests for a publicly traded company.
Really?
Oh, absolutely. It separates the companies that are merely surviving an inflationary environment from the ones that have completely mastered it.
Yeah. So for anyone unfamiliar, in baseball, a triple play is this purely defensive masterpiece. It's when a team is in a jam, runners on base, and through a sequence of perfectly coordinated split-second throws, they eliminate 3 players in a single sequence to escape the inning.
Right. It's rare.
Super rare. And in corporate finance, a triple play requires that exact same level of ruthless, coordinated execution. You have to beat analysts' expectations for your earnings per share. You have to beat their expectations for your overall revenue. And, crucial to the whole sequence, you have to raise your forward guidance.
Exactly.
But looking at these behemoths pulling this off, I have to wonder about the mechanics of those earnings beats. Like, if a company like Amazon or Apple is squeezing more out of their bottom line earnings per share despite skyrocketing global supply chain costs.
Right.
It almost suggests that inflation's acting as a cover. I mean, have they simply optimized their margins while consumers have been, conditioned to just accept higher prices?
That is a highly astute way to look at it. And honestly, the data supports that hypothesis. I mean, beating top-line revenue just tells us consumer demand hasn't completely collapsed.
Okay.
But bottom line, EPS, earnings per share, that is all about margin preservation.
Got it.
Over the last 2 years, these tech giants have enacted massive cost-cutting measures. They've streamlined their logistics, and crucially, they've leveraged their pricing power. Because they hold near-monopoly positions in certain sectors, they can pass input costs onto the consumer without severely denting demand.
No.
Yeah, they're essentially operating leaner than ever before while charging more.
Which brings us to the forward guidance piece, which is wild to me. Because raising guidance right now feels like walking a tightrope without a net.
It's incredibly risky.
Right. If a CEO tells the market, hey, we expect to accelerate next quarter, and then they miss by a fraction of a percent, the market will punish that stock mercilessly.
It is an immense gamble, which is exactly why raising forward guidance right now acts as the ultimate signal of institutional confidence.
Oh.
Think about TSMC, the company that literally manufactures the silicon brains for the majority of the world's devices.
Yeah.
When they say their future outlook is brighter than expected, it tells institutional investors that the foundational demand for computing power isn't just a bubble.
Right. It's real.
It's a sustained multi-year runway. And that level of confidence acts as a gravitational pull. It draws capital away from riskier sectors and consolidates it into these proven tech fortresses.
It's almost like the market is an airplane. And right now it's flying almost entirely on the thrust of a single massive engine called big tech.
That's a great analogy.
And that engine requires constant fuel, which transitions us perfectly to this hardware renaissance happening right now.
Yeah.
Because big tech's raised guidance directly translates into their capital expenditures, right?
Exactly.
They were spending billions upon billions to build the physical infrastructure of the AI era.
And that infrastructure is hitting very real, very physical bottlenecks. I mean, AI doesn't just exist in the magical cloud.
Right, it's physical servers.
Exactly. It exists in hyperscale data centers that are currently maxing out the available power grids and the physical real estate of the municipalities they operate in.
Which is exactly why the market reacted so violently to Micron technology today. Their stock jumped 11.4% following the announcement of a staggering 245 terabyte data center drive.
It's massive.
When you look at the sheer density as a 245 terabyte drive, it completely changes the calculus of a server rack.
It really does. It alters the entire CapEx profile for a company like, say, Amazon AWS or Microsoft Azure. Because the limiting factor for these data centers isn't just buying chips.
Right.
It's power and cooling. A local utility might cap a data center's energy usage at, say, 50 megawatts. If you hit that cap, you can't just plug in more servers.
You're just done.
You're done. So you have to cram exponentially more compute and storage capacity into your existing power envelope.
So density is actually an energy-saving mechanism.
Yes, exactly.
By fitting 245 terabytes into a single compact drive, you drastically reduce the physical footprint, which means you need fewer server racks. Which means you spend significantly less electricity on industrial cooling systems to keep the whole warehouse from just melting down.
Precisely. The innovation isn't just more storage. The innovation is power efficiency. So when Micron delivers a solution that directly solves the most expensive bottleneck for hyperscalers, the market immediately prices in a massive revenue stream.
It makes sense.
It's tangible hardware solving a physical limit.
Which brings us to, honestly, the most surprising hardware narrative of the day, Intel.
Oh boy. Yeah.
We saw Intel shares surge a massive 14% on reports of a potential manufacturing partnership with Apple. But I got to push back hard on the market's logic here.
Go for it.
Intel has spent the last few years struggling through a deeply troubled pivot to become a third-party foundry. They've faced delay after delay in their manufacturing nodes. Are we really supposed to believe that a rumored Apple partnership justifies a 14% single-day spike? Or are investors just so desperate for any hardware play not named NVIDIA that they are throwing capital at shadows?
It's a fair question, and honestly, it is a combination of both desperation and the unique halo effect of Apple's supply chain. You are totally correct that Intel's multi-billion-dollar foundry pivot, their strategy to manufacture chips for outside clients to compete with TSMC, has been met with intense skepticism.
Yeah, people haven't bought into it.
Right. The market has demanded proof that Intel can actually execute at the cutting edge.
And Apple is famously the most demanding client on Earth.
Oh, without a doubt. They have the most rigorous, secretive, and punishing supply chain standards globally. If you fail a yield rate for Apple, you lose billions.
Wow.
So when a rumor leaks that Apple is even exploring Intel's foundry services, investors aren't just calculating the potential revenue of a few million iPhone chips. They are pricing in absolute validation.
Ah, I see.
The logic dictates that if Intel's new manufacturing nodes are finally sophisticated enough to pass Apple's preliminary audits, then Intel's entire turnaround narrative might actually be real.
Because if Apple trusts them, anyone will.
Exactly. It implies they could soon attract AMD, Qualcomm, or NVIDIA as clients. So that 14% spike is the market pricing in the sudden viability of Intel's survival.
Okay, that actually makes a lot of sense. Yeah. The rumor isn't the catalyst. The validation of their manufacturing capability is.
Exactly.
But let's follow the thread of these massive AI data centers and global hardware supply chains. Because manufacturing advanced silicon and running hyperscale servers requires an astonishing amount of continuous energy and global transport.
Oh, yeah. Huge amounts.
And right now, the cost of moving anything around the globe or powering a grid is at the mercy of unpredictable geopolitical shocks. Which brings us to the exact reason central banks are sweating and really the other half of our split-screen reality.
Right. This is where the macro environment sharply diverges from the corporate tech environment. The entities responsible for maintaining global economic stability are, well, they're currently paralyzed.
Let's look strictly at the macroeconomic data dropping today. In April, U.S. private payrolls rose by 109,000, which topped economists' expectations. In the U.K., the economy surprisingly grew by 0.5% in February. So structurally, people have jobs, and the broader economy is crawling forward. But March core inflation in the U.S. is stubbornly stuck at 3.2%.
That's the sticky part.
Right. And because of that sticky inflation, the Federal Reserve, the European Central Bank, and the Bank of England are entirely frozen. The briefing notes that officials who dissented from the Fed's post-meeting statement explicitly voted no because they refused to even hint at a future rate cut.
Right. They are terrified of triggering what economists call the wealth effect prematurely.
Okay, the wealth effect. Break that down for us.
Sure. So if people see a rate cut coming, they assume mortgages will get cheaper, credit cards will get cheaper, and stock portfolios will rise. They feel wealthier, so they immediately start spending more money before the cut even happens.
I see.
And that surge in demand allows businesses to keep prices high, which causes inflation to rebound.
So it defeats the whole purpose.
Exactly. Central banks have a dual mandate, right? Maximum employment and stable prices, usually targeting a 2% inflation rate. Right now, the employment side is holding up well. Adding 109,000 jobs means the labor market isn't collapsing. But that 3.2% core inflation is the trap.
Because a strong labor market actually prevents the Fed from cutting rates.
Yeah, ironically.
If people have steady paychecks, they can absorb higher prices. So demand doesn't fall enough to force companies to discount their goods.
That is the core mechanism of their paralysis. If they cut rates now, they pour cheap capital onto a smoldering inflationary fire. But if they raise rates to aggressively kill that 3.2% inflation, they risk shattering the labor market and triggering a deep recession.
And complicating this delicate math are factors completely outside the Fed's control. Looking strictly at the Fed's calculations in today's briefing, Governor Waller pointed to the ongoing Iran conflict entirely through the lens of global supply and demand.
Right, strictly the economic impact.
And just to be clear for you listening, we're simply relaying the central bank's stated economic complications from the briefing here, without taking any political stance.
Absolutely.
But Waller specifically highlighted how the resulting surges in gas prices act as a regressive tax on consumers.
And that is the definition of an exogenous shock. The Federal Reserve can manipulate interest rates to influence domestic demand, but they cannot print crude oil.
Right.
They cannot unclog a global shipping lane. When geopolitical tensions cause energy prices to spike, that increased cost trickles down into the transportation of every physical good on the planet.
It's a vicious cycle for the everyday consumer. If gas prices surge, it immediately drains disposable income, hitting lower-income households the hardest. They are forced to spend a larger percentage of their paycheck just commuting to work or buying groceries.
Exactly.
The Fed sees this happening, but they can't lower interest rates to provide financial relief because doing so would just ignite broader inflation across the housing and services sectors.
They are trapped in a holding pattern. The briefing uses the phrase holding their nerve, which is, a polite way of saying they are crossing their fingers and hoping nothing breaks.
Yeah, seriously.
The structural resilience of the tech sector is basically masking the very real fragility of the consumer economy.
So how does a rational person navigate this? We've explored the massive capital expenditures driving the tech hardware boom, and we've analyzed the trap central banks are caught in. For you, the listener, looking at your own portfolio, how do you invest when the S&P 500 is breaking records, but the foundation of the global economy feels like it's made of sand?
Well, the briefing highlights a very specific pivot happening among institutional investors right now. It's an approach designed to capture the upside of the AI revolution while heavily insulating against the inflation trap. They are utilizing a barbell strategy.
A barbell strategy. Okay,
Yeah.
so one side of the barbell holds the hyper-growth, and the other side holds the heavy, boring stability. Let's break down the two specific funds the source mentions. On the growth side, investors are maintaining broad market exposure through ETFs like VOO, which tracks the S&P 500.
And the mechanism behind choosing a fund like VOO is critical here. Because the S&P 500 is a market cap-weighted index, the largest companies dictate the direction of the fund.
Right.
Right now, Apple, Amazon, Nvidia, and Microsoft make up such a colossal percentage of that index that buying the broad market is essentially a backdoor way to buy big tech's monopoly power.
Oh, that's interesting.
You capture the massive gains of the semiconductor and AI rally without having to pick individual winners and losers.
But the S&P 500 is highly sensitive to interest rate fears. I mean, if the Fed suddenly signals a hike, growth stocks get hammered. So what is the counterweight on the other side of the barbell?
Right, you need protection.
The briefing specifically points to dividend-focused ETFs like VIG, which tracks companies with a historical record of consistently growing their dividends. But if inflation is eating away at purchasing power, how does a dividend physically act as a shield?
Because a dividend is a tangible return of capital. When you buy into a dividend growth fund, you are targeting mature, deeply entrenched companies. Think consumer staples, utilities, healthcare.
Boring stuff.
The boring stuff, exactly. These companies might not be inventing the next 245 terabyte hard drive, but they generate massive predictable cash flows. They generate so much cash that they literally distribute a portion of it directly into your brokerage account every single quarter.
Regardless of what the share price does that day, even if the market panics over a geopolitical shock and the stock drops 5%, you are still receiving that cash payout.
Exactly. And in an environment where inflation is stuck at 3.2%, you need your money to generate a physical yield just to tread water.
That makes total sense.
Dividend growth companies are specifically chosen because they have a track record of raising their payouts year after year, often outpacing inflation. That cash stream lowers the overall volatility of your portfolio. You are funding your exposure to the breathless, high-risk AI future by anchoring yourself to the cold, hard cash generation of the present.
It's a fascinating psychological approach to the market's current paradox. You aren't fighting the split screen. You are actively investing in both sides of it.
Exactly. You embrace it.
Which brings up an essential question for you listening right now. When you evaluate your own financial strategy against this macroeconomic backdrop, where do your instincts pull you? Are you leaning into the momentum of the AI hardware supercycle? Or are you aggressively building a bunker of dividend cash flows to weather the Fed's paralysis?
It really requires a brutally honest assessment of your own risk tolerance in an era where, honestly, the old economic rules seem completely suspended.
We have covered immense ground today. We started by dissecting the defensive mastery required for big tech to pull off earnings triple plays, proving that aggressive margin optimization is thriving despite global headwinds. We explored the CapEx mechanisms driving the hardware boom, from Micron's energy-saving server density to the supply chain halo effect rescuing Intel's foundry narrative. And we traced the path of global energy constraints directly to the desks of central bankers, who are physically trapped between a stable labor market and the regressive tax of sticky inflation.
All of which leaves us staring at a deeply unsettling implication for the future of global finance.
Yeah.
If we are solidifying an era where the technology sector commands infinite capital to build out AI infrastructure, operating in this untouchable stratosphere of profitability,
Right.
while at the exact same time, the everyday consumer is permanently subjected to the crushing weight of elevated interest rates and geopolitical energy spikes.
It's a divide.
It is. Are we simply accepting that the stock market and the physical economy have permanently divorced? Are we watching the final fracturing of our financial system into two entirely separate realities, operating under different laws of physics forever?
Wow. That is a staggering thought to carry with you next time you're reviewing your quarterly gains. We're just standing at the gas pump. It fundamentally changes how you interpret the headlines. Thank you for joining us on this deep dive. Keep questioning the consensus. Keep looking for the mechanical why behind the market's movements, and we will catch you next time.